Speaking of $300 target, even now Bank of America just recently said that if you look at the gold silver ratio and based on their targets, they're saying that they're providing, or they're suggesting that silver could easily move up into a range somewhere between 125 and 300. I think it was $309 to be specific, but that was based on the ratio. And I mean, I think it's silly to be specific, but that's okay. And that's why I went with $300 as a round number.
Our projection is you could see silver this year $300 to $500 an ounce. Okay, now much of that should occur within the first couple quarters of that spread breakout, meaning much of it should occur by middle of this year in a Thunderbolt tantrum move.
Bank of America has stunned the market by projecting that silver could surge into a range of $125 to $309, a target derived from the historical gold-silver ratio. This forecast validates the view that the metal is severely undervalued, yet some experts believe even these triple-digit targets are conservative. Market technicians warn that we are approaching a Thunderbolt tantrum move, a vertical repricing event that could drive silver to between $300 and $500 per ounce this year. Unlike a slow grind, this move is expected to realize most of its gains by mid-year, driven by a violent spread breakout. Michaeloliver, founder of Momentum Structural Analysis, and silver analyst Peter Krauth predict that as the ratio snaps back, the speed of the ascent will likely leave hesitant investors behind. They argue that this tantrum will fundamentally reset the market's valuation in a matter of months, making current prices a fleeting opportunity. Now we present the clips from their interview. Before we continue to discuss this, please subscribe to our channel and activate the bell icon for timely updates. Thank you, and enjoy the video.
Silver barely corrects and instead trends higher. I mean, that just says everything. And if you look at the price action over, I'm going to say at least, let's say the last 9 months or so, the sentiment, I guess it would have to be from the smart money, has been where every little dip is being bought. That is just so, I guess, helpful in terms of how supported the silver price is, how real the tightness of the market is, and the whole sort of investment side of silver and how that really has come back. So you've got this perfect storm now of silver being added to the US critical minerals list, the EU designating silver as a strategic mineral, China all but banning silver exports, China already controlling 60 to 70% of global silver refining. So most of the silver has to go to China just to be refined. Guess what? They're not exporting it anymore. Of course, they do consume most of it, which is fine, but that means that most of the rest of the world now, if they want silver, which they counted on getting from China before, even if it wasn't produced in China, wasn't mined in China, although China is the second largest producer of silver, miner of silver, it's still way below Mexico, for example. It's important, but it's the refining capacity, and that is so highly concentrated in China. So if you want silver, if you want refined silver, which the manufacturers will absolutely need, you need to get most of it from China, and they don't want to export it anymore. India now has allowed silver as collateral for bank loans. And speaking of $300 target, even now Bank of America just recently said that if you look at the gold silver ratio and based on their targets, they're saying that they're providing, or they're suggesting that silver could easily move up into a range somewhere between 125 and 300. I think it was $309 to be specific, but that was based on the ratio. And I mean, I think it's silly to be specific, but that's okay. And that's why I went with $300 as a round number. But the point is that, and I can talk to, all these other fundamental drivers of supporting higher silver prices, but these are just some important points to consider. None of this is going away. The U.S., for example, imports 43% of all of the silver that it consumes, so it can't produce a little bit more than half of the silver that it consumes every year, and you can bet it doesn't refine most of it either. So anybody thinks that silver is going to correct and even and frankly even go back to anything anywhere close to below 50 at this point, I think that the odds, nothing's impossible. You can have these these outsized events, but I think the odds of that are so low, and the odds of it continuing to climb are significantly higher. So yeah, I mean, everything from inflation to consumption from data centers, AI, solar panels, everything's points to higher silver prices.
We think gold and silver going up a lot more this year, a lot more. Okay, multiples more. But silver is going to beat the pants off of gold. Silver is very depressed to gold. We all know that. It's been depressed for a long time, so that hasn't worked. But the technicals that say it's shifted into an outperform versus gold occurred in November at the close. By our metrics, we said, okay, game is on. Silver's going to launch versus gold. It's now up to 2% of the price of gold. Early this year, last year, it was at 1% of the price of an ounce of gold. So it's doubled in relative value over a year. And if you go back in history and look at where was an ounce of silver versus an ounce of gold as a percent, let's say the 1980 bull market peak when we hit $50, that old range, okay, it was at 6.5%. 6.5. We're at 2, okay. And in 2011 peak, when we hit 50 the second time, it was over 3%. We're at 2. Our technicals show us that spread relationship is broken out, and we're likely, think about this, silver's been in a 50-year, half a century dull range, suppressed, whatever. Gold hasn't been. Gold blows the heck out of every prior bull high. Copper's not where it was back in the 1970s, 80s, 90s, 2000. It's 4 times that price. Silver, for some reason, has been contained. Whether that's manipulation or a combination of events, it made a mistake. And whenever markets make a mistake, they tend to compensate for it and quite often overcompensate in a tantrum. This has happened many times in markets. It's not usual, but it happens. Copper did it in 2005-06. Lead did it in 2007. We quadrupled in a couple quarters to a new reality. If silver does that, our projection is you could see silver this year $300 to $500 an ounce. Okay, now, much of that should occur within the first couple quarters of that spread breakout, meaning much of it should occur by middle of this year in a Thunderbolt tantrum move.
Silver's refusal to make a deep correction signals a market dominated by smart money aggressively buying every dip. This strength is underpinned by a perfect storm of geopolitical shifts, including China's export restrictions and the West's sudden designation of silver as a strategic critical mineral. Strategic market analysis emphasizes that this fundamental squeeze is intensifying rapidly. With China controlling roughly 70% of global refining and halting exports, the U.S., which imports 43% of its consumption, faces a severe bottleneck. Simultaneously, major institutions like Bank of America are setting targets as high as $309, validating technical models that see the gold-silver ratios breakout, signaling a violent catch-up trade driven by shortages. Market history suggests that assets suppressed for decades eventually overcompensate in a Thunderbolt tantrum. Technical indicators confirm the spread relationship has definitively shifted, targeting a massive vertical move to $300 or even $500 this year as silver finally breaks its 50-year containment. Let's get back to the interview.
My forecast, my ultimate peak, in a silver price, I had said was going to be up to $300. And I was not trying to be sensational. I said, here are the ways I think we're going to get there. But as you can imagine, you have to make assumptions to justify. And so one of the assumptions was that I was looking at the gold silver ratio, and I said, all right, well, if I'm going to use that as a bit of a guide, one indicator, we need to make an assumption. And if we're looking at where the silver price will go, well, the assumption will have to be on the gold price. And my assumption was that we would see $5,000 gold. Now, back in 2022, that sounded a little aggressive, but it doesn't look that way today at $4,600 as we speak. So we're less than 10% away. I think, we're seeing forecasts from now mainstream, financial and news outlets and investment banks and so on, that 5,000 is, a given, very likely this year. And I would not argue with that, given how things are going. So, with that one assumption, $5,000 gold, and if we look at, let's say, the long-term average in the silver price over let's say the last 20 years, not the silver price, but the gold silver ratio, that would probably bring us to somewhere around, say, 55 or 60 in the ratio. Well, we're at 52 already today. I believe it can go lower. And so, and it likely will go lower, because when we get these kinds of phases that we're in now, it tends to quote unquote overcorrect. And so I think that the ratio could potentially go down to 40. So if you had, $5,000 gold, and I'm using my calculator now, and divide that by, let's say, 50, we're looking at $100 silver, where we're almost there. If the ratio goes lower and gold goes higher, frankly, I think that, it's not unrealistic to see silver to maybe reach 125, perhaps even push 150. Again, it's so hard to look out. We've had such a huge move already in the last several months, several quarters, even. A pause at some point, perhaps soon. These big numbers like $100, which is now very close, are psychological milestones. And you could get a bit of what I would call maybe a bit of a reckoning or so at that point. Perhaps we would get a correction. Silver is volatile. People need to keep that in mind. Corrections can be pretty volatile and quick. And so, I had been thinking $50 would be the new floor, but now, given where we are, frankly, I think more like maybe $70 or $75 will start to act like a new floor. And I think realistically, we could see 125 later this year. And the moment silver broke 50 and demonstrated that that was the new floor, and that it was going to, we were in new territory. So anything from that point was possible, and I'm going to say even likely. And so it's certainly not a complete surprise that we've gone from 50 and ran to 70 and 80 and now even 90. I will say, personally, I am surprised at just how quickly it did that. But the drivers, which we can talk about, I think certainly speak to that and justify the kind of run that we've had. There have been so many developments, and it's not unrealistic. It had been, if I look back a couple of years, I've said in presentations, I considered silver was, the most undervalued asset in the world. And frankly, at $20, when it was costing almost that price to mine the metal, there was so little margin for the miners that it was next to impossible for it to go lower. And the upside was, the odds for considerable upside were just based on all the drivers were just so compelling that they made the case for these kinds of prices today.
If that fever has been driving silver and gold over the last few days, for example, then yeah, it might create a correction. But the question is where? Where do you go before you get that? And I'm of the view that probably you're going to be well past 100 before you even see a correction that you could say, oh, there's the midpoint of the time 6-month span where you get a wobble. Anyway, it's an important level because people who got calls got to be concerned about that,
And so your point is, if we do get a correction because of the Supreme Court ruling, and we get a correction in gold, we get a correction in silver, and it pulls back, let's just say 20 or 30%, given the moves, it wouldn't surprise me at all to see that kind of a pullback. But that's a buying opportunity. That's when you got to step in again.
Yeah, no, this bigger reality is not based on the things we see now that have just occurred. Tariff, for example, that only became a market term in 2025. Before that, it wasn't an issue. We still had a bubble stock market well before we ever had tariffs. Okay, it had a 15-year bull that took the S&P up tenfold and the Nasdaq up 20-fold over a span of decade and a half. Money printing, M2 growth, free money in the Fed funds rate. So you already had a bubble. So this issue of the tariff coming, going, that issue, is not really the factor. It's the newsy factor right now, but there's bigger issues. Same with the T-bond market. It's not in trouble now just because we have tariffs. It's in trouble because it's in trouble. Jamie Dimon has said that for months. You can't keep playing this game decade by decade, and you've got to face the consequences pretty soon. That you've got a spending problem versus the GDP, et cetera. So anyway, we're in that, and don't run if you've got leverage positions like I do. I have some leverage positions, especially call options on SLV, for example. I'm keen to move those over and move more into unleveraged at that point, because the big move is still coming later this year, after this jiggle, whenever we get the jiggle.
With gold rapidly approaching the $5,000 mark, a level now considered a conservative mainstream forecast, the implications for silver are explosive. Analysts project that as the gold-silver ratio compresses toward 40, silver is primed to shatter the $100 psychological barrier and push toward $125 or even $150 later this year. While short-term volatility is expected, with $70 to $75 establishing itself as the new hard floor, any reckoning or correction should be viewed strictly as a buying opportunity rather than a trend reversal. Strategic market commentators argue that current headlines are merely newsy distractions from the larger reality, a 15-year asset bubble that is finally unraveling. They advise traders to use any upcoming jiggle, potentially a 20 to 30% pullback, to transition from leveraged option positions into unleveraged physical holdings, securing positions before the next major leg up. Share your thoughts on their analysis in the comments section below. If you find this video informative, please support us by turning on notifications to stay informed about our latest videos. See you in the following video. Thanks for watching.